Hello ladies and gentlemen, and welcome back. Well, just when you thought markets were going to get out of control, they pulled back and created rejection pin bars. We also saw the Nasdaq fall from a level where it took out the previous highs before rejecting. This shows you the types of markets that we're in right now. FOMO was great in the previous session. People were fighting on Twitter. Everyone had to have a discussion point about what they thought the markets were going to do next. And on TV, from what I've heard, the reports are people are going super bullish. So are they correct, or is it time to actually really pull it in and say, well, maybe we need to look at this market objectively? Remember, we've left behind a lot of gaps on the way up here. And while the bottom may be in some ways based on statistics of getting past what we call the 50% Fib level, that doesn't mean that pullbacks don't occur. Stay tuned as we look at the human psychology right now of these markets, because it's super interesting and you guys will enjoy it. See you soon. Well, welcome back everybody to the Daily Show, where we talk about stocks, commodities, and cryptos. We've got an exciting session today because we've got so many things to discuss, including our charts and key levels later on today's video. But first up, macro, and specifically let's look at US put to call option volume. What you'll notice is I've highlighted down here the point of March and April previously. We saw it go from heavy buying of puts to a heavy buying of calls. What have we seen just recently occur in the last 24 hours? A heavy buying of puts all the way to a heavy buying of calls. It's amazing what basically 1 month can do in terms of changing sentiment and of course completely shifting or 180ing this market from everyone thinks the next end of the world is going to happen to everybody suddenly thinks the next bull market is happening. Sentiment votes are in. This is before the CPI number, by the way, and people were already leaning towards a lot less bearish than they were a few weeks ago. 36.7% of people bearish, 31.2% of people neutral, and 32.2% of people were bullish. This is from the AAII survey taken up until Tuesday at the close. Let's move over now to the S&P 500 data stats that we've been using recently. We've talked about when it goes from lots of puts to quite a few calls and what ends up occurring there. Well, we end up getting this kind of stagnation in markets. If we have a very small move like we had in the previous week, and then we have a huge amount of calls being opened, you can see the data and the stats don't really lie behind that. The market tends to be down to flatlining for a few months after. And this really meets into one of our core principles of what's going to happen or what should be happening over the next couple of months. First up, we have here the 2002 into 2003 crash. You can see that we were bottoming, very similar to where we are right now potentially, yet we still went from huge amounts of puts into calls, and then it took a little while and we got that kind of double dip. Could we be seeing that again? It's certainly a very big scenario. Here, back in 2008, we saw a very similar scenario. We went from huge amounts of puts to a huge amount of calls. We got that secondary dip, and then of course the bottom was in. Again, a very, very interesting period of time. If we also think about how long we've stayed volatile this year, we just saw the VIX, which is something that we've talked about heaps. The VIX go from above 20 all the way back underneath 20. Now, when this occurs, you'll notice the stats, especially the most recent stats here, haven't always been so favorable over the next couple of months. It fills into that idea that there's going to be a trader's market here, potentially through the midterm elections, maybe at the end of the year, at the end of 2022, we do end up seeing a resurgence of bull market. But at this stage, you'll notice really a lot of signs towards potential 1 to 3 month weakness. The stats don't really lie here. That's often what's happened in the past. Something we should keep in mind. Midterms as well, no one's discussing these, so I always bring them up. Volatility expected to spike through that September, October, and middle of August on. We've got the big options expiration next week. We'll talk about that later in today's video. So many things going on. And I'd also never discount the idea of lockdowns in China as well. No one discusses that right now. It was a catalyst for the last drop. Could it be a catalyst again? I've heard it's growing over there. It's very difficult to figure out the stats, what they're going to do. But in general, they've been basically snap locking down most of the cities that ever have those breakouts. That could hit the supply chains. Again, inflation becomes a problem, and you guys can figure out where it goes from there. Where are we right now? Well, we mentioned this at the start of the week. It's our kind of two scenarios. The scenarios based on stats. The small pullback into the huge rally and the small pullback into a dipping market, possibly even a new low, but most likely kind of coming back and testing those previous points. Again, these are just the scenarios based on previous times, the most likely events occurring, and we're at a point critical. We've done the reverse rally. We've been following that now. We're at a critical point, which we'll be looking at in the charts, and everything really can be made and broken in the next couple of weeks. Also, midterm years, you'll see here, especially with Democrats' second year cycle in the cycle, September and August tend to end up leading into negativity, but October, November, and December, at least historically, have been incredibly strong. So again, expect volatility over the next couple of months. We don't have too many catalysts moving forward either, so the market's going to be allowed to leave itself to its own kind of reasons. We've seen the big earnings come out. We've got the inflation number coming out. You know, it's going to be less news and more market participants deciding what's going on. Q2 earnings still at 62%. Well, actually, that's a drop, I think. Beats 1974 versus misses 1,196. Pretty crappy earnings. Obviously, the market is not being driven fundamentally necessarily here. It's just expectations of a soft, what they call a soft landing or a Goldilocks kind of inflation scenario. Here's the VIX. We'll get started with the chart. Straight away, you'll notice the VIX underneath or around 20. Key critical point. We've mentioned this heaps of times. If we go back to the dates, 10th of Feb, obviously 1st of Feb, we know what happened. It spiked both times, creating volatility in the markets. We saw that March-April period. We got a huge spike in volatility. That was the kind of case scenario that we're looking at very similarly to now. And the VIX should be respected over this period of time. It's not like the bond market really thinks that the yields are going down either. It's held against the inflation and the PPI number. And this again shows us that if we see this number creeping up, let's say the 2-year continues to go up, it has a correlation with the market. Watch the 2-year yield. If the 2-year yield is going up and the stock market is hovering and this continues to go up, it's a huge warning sign. We've seen it a lot in 2022 and we'll continue to watch it together. As we mentioned, put call ratio, you would think with a little bit of a down end session that you might have seen a huge amount of puts opened. Wrong, calls were being opened at a faster rate. And that's, of course, what we want to see if you believe the market could be going down. Now, there's always two cases to the scenario, and we will be looking at both, but that's a big one there. The bullish case is pretty much firmed here, which is this S&P 500 stocks above the 200-day moving average. Now, this is more of an investor's kind of indicator, and what you're really doing is instead focusing on these lows. And if you go back and look at some of the dates that you hit these levels, January 2016, December 2018, if anyone was trading that, you would have known that was a very good period of time. And then, of course, March in 2020. This is a very, very cool indicator to really have around that 14, should you be looking at doing dollar cost averaging or anything else. And what this is showing you is a pretty decent recovery in the markets. Now, that doesn't mean that we don't have a dipping down, or like similar to even what you had in 2020, which was about an 8 to 10% pullback at that point. But it does kind of point this picture of, have we seen the lows again? Some stats will say now, yes, we have, but the pullback is probably going to happen. And that's something that's very important. Some people also say, look, we haven't even seen it yet. There's arguments to be made both ways. And that's why Twitter is going out of control at this point. If you're feeling bearish on the markets, you want to see the US dollar rise back up. It actually broke through a daily trend line, which you'll see I've got here. This is only a 1-hour chart, but I wanted to point out this most recent price action. Basically, if we get through here, which is the 105.46, we should be able to ramp a bit on the US dollar. Now, the initial reaction to the inflation number was US dollar just fell off, instantly fell off. It came down to this level here, and then it bounced, it came back down, and then it's bouncing again. Now, a lot of people know this as a double bottom style pattern, but what I was most interested in the last session was this little area here sitting around the price of 105.06. We broke through, pulled back a little bit. Basically, there was probably a lot of supply there, and then we moved up further. I wouldn't be surprised at all to see this level get taken, a pullback maybe down to around this 105 level, and then a potential reversal here on the US dollar. If the USD does break out, expect the stock market to probably find weakness around that as well. And that could be a good warning sign that maybe the USD has one last pull in it. And the main reason is actually because so many people will be bearish on it now. Look at this trend line going through. Did it break low? Absolutely. Now, if it goes higher, what does that mean? It could invalidate and move back through. There's a lot of fighting to be done between the bulls and the bears moving forward right around this level here at those highs. So definitely check it out. Equal lows on the daily as well is a pretty big warning. This is a critical time for US dollar. It needs to be focused on in the next 24 hours. Gold did what we hoped it to do. It basically rallied back up. Anyone in our private community would know we were streaming about this in the previous session, talking exactly around that 1800 zone. It ended up rejecting it, coming back down. Now, if we get through 1783, gold most likely will move to the next key level, 1770 or even 1755. These are two huge supports, and you guys will know now that I'm pretty bullish on gold. I just think that gold needs to have that little bit of a pullback after such an epic run. Basically, look at this daily. We've got rejection off the area that we were discussing, that 1808 area. It's then come back up, rejected it, two bad looking candles. It's time to put up or shut up, I guess, in this area. If the dollar index ends up getting bullish, of course, it should be able to push gold down against the US dollar, and then we move into those key levels. I'm really excited for gold. It's one of those times where I think gold is worthy of trading more so than it ever has been, and that's super exciting for many people because gold is often a horror show. Like it's been bad for a long time. It's getting exciting, it's getting interesting, the volume's there, the volatility, the money flow, it's all happening. US oil hit to a pretty key critical zone. You obviously have sup, res. We spoke about this candle in the previous session being a bit of a spring. I couldn't deny, even though I'm long-term bearish on oil, that it did look pretty good. That's a nice little kind of Wyckoff base here with the max pain, with the spring component, and it broke through. I would say that at this stage, you would think sell-offs will be rallied. It does look relatively strong. It's not like the super duper you're going against the trend and everything like that. Obviously, that's risky. But what you're looking for here is a breach of something like this 96.50. If that did happen, any pullback you would think would be met by buyer demand, and we could potentially be back at 102 or even 104 relatively soon. Be very careful on oil. It's at that role reversal area. Maybe the trade was just in the slingshot to this movement in the previous session. But this is interesting because what we're seeing across the board, if you look at soft commodity, if you look at lumber, if you look at any of these things, is after that inflation number, everything went up. So like things like copper have gone up as well overall after the inflation number. This is kind of showing you that maybe the market is just putting all these things back in and actually inflation is going back up again. Remember, the big reason why we saw the inflation number down was really due to energy. What if we see $103 a barrel again on US oil? Pay attention to that because that's going to mean the gas is going up across the world for everyone that's driving cars. And all of a sudden that's going to show itself, guess where? In the inflation number. Don't be surprised by the inflation number. You can almost see it in front of your eyes when you go and fill up your car. And that's a huge portion of it, obviously, when you do anything else. So always watch that. XJO, ASX 200 could actually benefit from such a move. You've got to be careful around this point. It's going to be limited by the S&P 500 if it does start to weaken. We are at mission critical, you would say, for the ASX 200. This is the top 200 Australian stocks. It's really around that kind of key zone. I think we'll probably do a little bit of a special on the weekend and look at some of the builds in it. But effectively, it's just slowing down heavily. There's a lot of divergence here, and it's very similar to some other stock markets right now. Tesla, over to a couple of American stocks. What's going on here? Well, Tesla, as we see, broke through that trend line. It's coming back down. Every day is red. So it's red, 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 red. It finds bid in the morning and it sells off by the end of the day. Now, that's not necessarily the greatest thing to see in a stock. We know Elon sold pretty large portions of stock. We could make arguments all day long about that. The biggest problem here is really just going to be if we break through this support. So if the market starts to tank and we get through 840, watch out down below, guys, because the next support for Tesla is probably around 774, 775. quite a lot lower than the current price. Certainly need to be concerned about that if it does get through this little level here. Watch it, be careful. Series of lower highs coming down, so that's lower highs. The bid is not strong currently for Tesla, and of course if the stock market finds weakness, we need to watch out. Apple hit the top of the box, 171, almost perfect here. I think it was 170.99 it hit at the peak. It hit that top of the box. That was the second target. It's left behind gap on gap on gap. It's now up 4 or 25% since July. Smells a lot like this. Too much rally in a stock that, yes, Apple is great, but Apple is also loved by retail. We're seeing a lot of options calls all over this stock. People are piling in, not necessarily the thing you want to see if you think it's a healthy style recovery at this stage. Move over to IWM versus the SPY. This is, of course, the Russell 2000 versus the S&P 500. You'll notice here that it's starting to get close to that resistance. We mentioned it because this is what was causing a lot of the dips back in 2020. June dip and also the August into, of course, the rally when it broke through. We're at the critical point right now. We just rejected it, which was that 0.47 ratio. Watch this space. Obviously, if this breaks through, you've got to be feeling pretty confident about the rally at that point from the perspective of a broad-based rally. DAX, not much to say, sitting right at the resistance. Probably skip this one today, really. Then we'll move over to IWM by itself. Gapped up, looked good. Still has probably a little bit of a gap in here. It's obviously left behind that one there. Russell 2000 hit almost 200 perfectly, and then it's falling off at this stage. So look to this one over the next couple of days. Small caps doing pretty well. Got through one of the key levels that we would have thought was a big zone, which is that 194, 195. We had that for a while. It's now above here, so a lot of people will have triggered buys in here. This is perfect timing should it wish to come back down. I think you'll find that in most of the markets. Take QQQ for an example. This is the Nasdaq. The Nasdaq ETF here actually made a new high. It took out here, here, and here. Now, some people can see this as what they call a swing failure pattern. Effectively, this is a pretty critical kind of move, and this could be the beginning of filling a few of these gaps. It's very common that a market will take like a high or something like these key critical zones. Notice over here, it took that high as well. We've seen this play out before. In most cases, it's been bearish. Oh, I tell you, it is in most cases usually a bearish kind of level. So we'll find out whether it continues to feed through. Let's have a look at the S&P 500. Now, before we actually go past the futures, I just wanted to show here, no follow through yet past 4,200 in terms of shorting. But that's what the ES kind of futures looks like at the end of the day. Let's go over to this, which would look confusing, which is why I didn't put it on the chart straight away. This is actually our boxed red zone that we've had for ages. We have talked a lot about some form of rejection happening in here. Our first level was 41.20, the 20 moving average. Of course, we didn't see any real sell-off action there, but now we've just hit absolute critical points. First up, we hit the 50% Fib pullback. So everyone's talking about this, which I always hate when everyone's talking about something. The 50% Fib pullback for 70 years has usually meant that the bottom was in. That is, that was the low of the market. It didn't mean that it didn't come back down and swing like this and get very close, but it generally meant that the bottom was in the market. All right, that's 70 years of data. It's not my opinion, it's just what it is. Now, it actually broke and got above that 50% Fib. It also hit just above the 61.8 Fib of the last pullback, and both of these zones were very closely packed together. What a critical zone. We've mentioned it several times. We rejected that. We basically created a shooting star style candle with the market gapping up, closing the gap, obviously after a rally, and did it suck in enough liquidity? We've got a gap left down here, 41.20. A lot of people want that at least minimum. I don't blame them on that one. That's going to be pretty critical. So 41.20. And then we have just, I think it's like 4 or 5 gaps below through all of these zones that have been left behind. Now, gaps don't have to fill. Someone asked the stat. I think it's 75% of them do fill within the month. However, that doesn't mean, again, there's still 25% that don't fill for a very long time. And it can take years, if not, sometimes some gaps take decades to fill. So it's not just the only reason you would place a trade or do anything. But what a critical area we are in. We hit the 50, we hit the 61.8. We didn't fill this one over here, which was a gap left behind, but we did certainly get a rejection. You know, you get a secondary day here on Friday. All eyes are going to be on Friday. What if we see a doji, an indecision candle, and then we see a new low? Wow. That'll be a big deal. So watch this space. Certainly in the S&P 500 showing weakness. Let's look over to the futures market. Look at the 1 hour. The problem, or the biggest issue that most people are going to have here, is there's just not much demand levels, or not many demand levels, to really prove that we're going down. This has just been like ramp. And at the moment, we could still go down to 41.20 and not even get through our blocks that are behind here. So many of you guys would know that we've had two key zones obviously sitting behind here, and the second key zone sitting behind this big one. We've used that to really hold our bullish pressure on these positions for a little while. 40.80, 40.90, and the 4110 to 4115. These two levels really represent the bullish demand in this market. Should the market come down and clean up the gap that's here, it will hit straight into this demand level. It still hasn't actually changed trend at that point. It would need to take these levels to change trend, and then rallies should be met by sell demand. So at this point, it's still technically bullish. There are many reasons to potentially feel bearish. It hit the 61.8, it hit the 50. There's people going crazy. I'm telling you, everyone in the comment section is probably going to be mad. You know, it is what it is. This is the time that really you have to get clarity in these markets. It's tough. It's tough, guys. You know, it's pushing and pulling your emotions. It's doing everything. And you've just got to have plans. That's why I often set options position myself, because what I do is I average and scale into concepts. If I think it's bearish, let's say here, and I know that I don't have price action on my side, but I know that maybe over the next 2 to 3 months, I believe it's bearish, you can place positions as it goes up, and you might end up filling into your perfect scenarios, like in these levels or even a little bit higher. That's a trade in itself. You're fixing your risk. Ideally, you're setting positions. The other time is when you're scalping and day trading. Why do you care? You're just following the trend. All you're looking for is your replicable strategy to pull it off. Do you care if it's bullish or bearish? Not really, but you really need to recognize if you're taking bullish positions up until really where we've been recently into our key zone, it's been better to be a bull and better to take the positions in the direction of that overlying trend. Always remember that. If you're scalping and you're trading in the direction of trend, you can afford to let some runners on. If you're scalping against the trend, be fast and be nimble. It's super important and worthwhile to consider. Let's have a look at the options expiration on Friday. A pretty big options expiration. 414 is technically where max pain is. We haven't been hitting max pain recently. It's not the 3rd week options expiration, so it's not the big one. But check out this. There is real issues here in these markets. There's buyers, there's sellers, the puts, the calls, they're all confused. No one knows what's going on. And that's putting us at a 414, but you can see here, big difference. Next week, where it gets interesting. So make sure you subscribe to the channel, because next week, we're talking about a 402 max pain, 3rd week expiration, and check out how much more is here. There are big put levels sitting at 400, 390, and 380 that will probably expire worthless. You never know, but huge levels. And there's all these people that have suddenly started coming into the call party, and they're just putting smatterings of calls all over. So we've got the 420, the 430, the 440. You know, people are getting super bullish for this next week as well. There's a fight between the bulls and the bears. You're seeing it play out in options. And remember, I'll be bringing you what retail traders have been doing on the weekend video, so make sure to subscribe for that. Ethereum didn't quite get to 2000, 1941, and it rejected a little bit around there. Critical zone here for Ethereum, big psychological level. Still technically in a bullish trend, so you can't really say against that, but I would say it's at that critical zone where a lot of people will be taking profit. They'll look at this and say, yeah, too many issues here. I wouldn't blame them at all. If you haven't already, come and follow us on Twitter. We're posting a whole bunch of great charts there. At FX Evolution is our handle. Come join us in the Discord community or our private Discord community, 7-day free trial if you're interested in the streams that we do pre-market open. And for the rest of the data, it's really just prelim UOM sentiment, 10 a.m. New York time for Friday. Thanks so much for watching. If you enjoyed the video, make sure to slam that button in terms of the like and the subscribe, and we'll see you in the next one. Thanks so much, guys. Good luck out there. It's tough being a trader or an investor right now. You don't know which way to go. And that's because this is the way the market likes it. Keep you guessing at all times. See you soon.